Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist Phil Putney. Now let's get rolling with today's show. Welcome into another edition of Phil's Tax Hacks and Other Retirement Facts with Phil Putney and myself. And it's time to talk about five, at least I have the top five, 401k mistakes to avoid with the new year upon us. Maybe it's a good idea to think about some of these things as we launch into a brand new year.
Brand new year, 2023.
I know, right? So I figured, Phil, this is a good thing to chat about a little bit, as making adjustments to, accounts. If you're working with somebody, you might be in that period where you got to make some changes.
Yep.
Whatever, maybe you're starting a new job, but lots of little things to talk about when it comes to the 401k. And I want to set it up by saying we're not going to bash on the 401k.
No.
Just want to highlight some areas where, because it's a great vehicle, right? I mean,
absolutely.
If nothing else, right, it's an easy, painless way to save, right? I mean,
right.
But that's also kind of the downside. It's so easy and painless that you kind of set it and forget it.
Right.
Don't make any changes to it for long periods of time. And that could be where some mistakes come in too. So just want to highlight some areas for folks to think about.
Absolutely.
Yeah. And I know you've got a couple bonus ones as well. So we'll go through the ones I've got and then we'll have you
add a couple at the end. So, all right, good deal.
So let's start with a simple one. Sure. Job change. Yep. You've moved on. You got a new gig. Awesome. Right. Mm-hmm. Just don't leave the old 401k behind. It's not doing you any favors sitting back there.
Right. Yeah. I mean, I often run into what I call financial collectors, right? I mean, they've left jobs and left jobs here and there, and all of a sudden they've got all these 401k accounts. In fact, I've had some clients that we've helped, bring some of these together as they retired. And then 6 months, a year later, they'll come in, hey, I found another one.
I found another one. I know. It always
it's great. Found money.
Found money, right.
Yeah, that's right. Well, no, that was really your money. So
I find $10 in a pocket and I'm super excited. I can't imagine finding a whole account somewhere.
That's right. Well, and the downside of that too is if you forget about it and the company can't find you, they're going to end up sending it to the state to the what's called the Escheats division of, because unclaimed properties.
Yeah. Yeah.
So you don't want that to happen, so you want to be able to keep track of these accounts. So it's generally a good idea you're either rolling it into the current company 401k or rolling it into an IRA that you control. And there's pros and cons.
I was going to say,
both sides of that. So
that's probably the biggie, right, Phil, is that nothing else. You just have more control if you don't leave it behind.
Right. Well, and it's easier too, right? I mean, instead of having 5-6 statements coming in quarterly, monthly, whatever it is, you minimize that down to 1 or 2. So you can better control and manage where things are at and what's going on.
And options. I mean, you're going to be whatever options were left behind and you're no longer there.
Right.
It's just a whole lot of reasons that it makes zero sense to leave it behind. If it's low enough, Phil, like if it was just a smaller, like if you were kind of job hopping and it's a small enough account, a lot of times, like I had one I totally forgot about. Actually, I made that joke, but yet I'm guilty of doing it. And they rolled it into an IRA on their own, like the company put it into an account and then with a bank and then sent me the letter and said, hey, here it is.
Go get it if you want. Yeah.
Yeah. Here's where it is. Go get it if you want it kind of thing.
Well, you've got to be careful too. Some of the plans, especially if it's a low balance, a lot of times it's like $5,000. Yeah. If the account's under $5,000, if they don't hear from you, they'll distribute it. So all of a sudden you got this money, check shows up in your mail and you think, oh, it's great. Well, it's great, but it's all taxable income too. So, and by the way, there's a 10% penalty if you're under 59 and a half. So,
So, and if it was like, $3,000, you basically aren't getting much out of it anyway.
Right. And they mandatory have to withhold 20% for federal. So, I mean, it's not a good thing. You don't want to leave accounts behind. Yeah, make that part of your process. If you're making a job change, don't forget the old 401k. What are we going to do with it? Are we going to roll it into an IRA? And there's pros and cons to that. Roll it into the current company's 401k if they have one.
Yep. But do something.
Don't forget it. Yep. Do some housekeeping. Clean it up.
That's right. Exactly. All right. Number 2, failing to rebalance often enough. Now, many of these will auto rebalance, right? To a certain degree, you can get some auto rebalancing in there. Right. But if anything, 21 going into 22 might have taught us a lesson, a reminder. Don't forget to rebalance every once in a while. Because if you were taking a lot of, if you were high risk
and
in 21, you weren't so happy with that in 22.
Right. Yeah. And that's really, rebalancing, not just within the account back to the original allocation, 20, 30, 40% into the various funds, whatever it is, but also just reevaluating risk, over time. I can't tell you how many clients that I meet with that looking at their allocation and it's like, well, you've got, like 80% equities here and you're 60 years old.
Yeah.
Is that your comfort level? Is that kind of your risk tolerance? Oh, I haven't changed that since I started, 25 years ago. Which played out really well the last, 10, 12 years, but hey, you're on the brink of retirement now. And especially if they were in that allocation now, probably wasn't the experience you were expecting.
Yeah, your tolerance level may have changed in 25 years, just a guess.
Just a little bit. Yeah. So reevaluate, not something you should necessarily change your risk tolerance every year because now it's reactive.
Right.
But do a risk tolerance assessment. Just understand, what am I really comfortable with?
And some of these things will sort of rebalance on their own. So kind of my next one here, target date funds, for example, right? That's kind of the thought process. They go, I don't know where I need to go into. Right. I'll pick this fund because 2040 is when I'm supposed to retire. Right. And cool, it's now customized for my retirement year, and all that kind of stuff. And there's some misnomers to that, right? It's easy,
Absolutely.
It's great. But there's some better options, really, truly.
Yeah. I mean, it's funny. I call this the easy button, right? And hit the easy button and just put it in, and it's going to auto readjust to some extent.
To some extent,
it's on this sliding scale. So how target date funds work is that as you come closer to that target date, it starts to become more conservative.
Right.
To me, probably the biggest misunderstanding in target date funds is, what does that target date look like? Because most people think if I have a 2022 target date fund, well, by 2022, it's really conservative because that's when I told it I was retiring.
Right. Yeah. It's down to like 10%.
No, not really. It's 60-40 portfolio usually at that
Pretty
point.
much,
60% stock, 40% bonds, right?
Maybe 50-50, but
maybe 50-50. It's in that range. It depends on the target date. But I mean, it's definitely more aggressive, I think, than most people really understand, which there's not a problem with that. Just understand what it is. Don't, understand the expectations of what the fund's going to do.
Yeah.
So, and the
fees, I was going to say fees, right? That's
fees are very, very low in a target date fund because it's an index, right? They're simply moving between stock and bonds within this over time. So it's indexing. So it's going to be very cost effective from a fee,
which makes
but there is no oversight. There's no management. It's on a preset sliding scale that every year as you approach the target date, it moves more out of the bond or out of the equities into the bond allocation.
And most advisors I talk to are like, it's a great, easy tool, but there's really better options. If you're not doing any, having any professional help, fantastic. At least you're doing something. But
I mean, it's better than looking at the funds and saying, looking at the last 10-year historical returns and saying, oh, this one looks good. And this one, I'm going to do all those,
Yeah.
If you have no idea what to pick, then target date's probably an okay option to start with. If you're not working with an advisor, a better option is have an advisor to have a plan.
Yeah, and they're going to probably have you do some other stuff.
This is where it fits, and this is what you should be doing. So,
So again, not bashing it. Don't beat yourself up. It's better than nothing. But again, these are some common mistakes or some mistakes that people don't think about because there are some better options or some better things to think about out there. All right, number 4. This one's a little more higher level, I think, but just kind of don't forget that we're not the client, right? So as a participant in the 401k, we're just a participant. The client is who you work for. Is your boss, basically the company that you work for.
Yeah. So, I mean, 401ks are very interesting vehicles in that your employer pays money to have this 401k potentially, right? So, I mean, there's a lot of things behind the scenes that are happening inside of 401k.
And they're often looking for a good deal for themselves.
Yes. I mean, the company is wanting to provide the employees a benefit. I mean, it's a great incentive.
Right.
It's a great offering to have for your employees to help them stay. I mean, you really need it in today's market to be able to retain employees and attract the right ones to have retirement plans at a minimum. But it's a cost to that company, right? So the 401k provider isn't as interested in you necessarily as they are that company because that's their client. The company is their client. So they're interested in maintaining the plan, which is the collection of all the different employees' accounts together. So, and they may offer services to individual employees, which is great, but again, just understand that their focus is really that company, the plan itself, not necessarily you as the individual.
Okay. Number 5, fees and costs, assuming that they're always minimal, especially when we don't see them or they're not illustrated clearly or easily.
Yeah, fees and 401ks are always I want to call it smoke and mirrors, but it's you can't figure out what's going on in a 401k. And
like trying to read your cell phone statement. If you really try to break it down, you're like, what
is this fee here? Yeah. I mean, at least on there, they tell you that here's a fee, I mean, in the 401ks, oftentimes you don't see that.
That's true.
And the challenge with most 401ks is that if you look at the investment options in a 401k, oftentimes they have a similar name to a outside mutual fund, but it's not the same. It isn't truly that mutual fund that's inside that 401k often. Usually it's its own kind of mirrored trust type account that is for 401ks only. And the reason they do that is it's designed for company plans and 401ks where there's all this fee arrangements between companies and the providers. And again, back to our previous discussion, the provider is working for the company. So the company is trying to get this plan at a lower cost. The provider still needs to get paid.
Yeah.
So if they use these different types of accounts, they can work fees in different fashions that are outside of a mutual fund, right?
Yeah. There's front of the house business, but then there's back of the house.
Back of the house business, right? So yeah, 401ks are they're really tricky vehicles from a fee standpoint. It's understanding different options you have. So one thing that we didn't mention in here is the whole Roth side of the equation.
True.
I mean, something relative, I don't call it new. I mean, it's probably the last 10 years, but it's relatively new.
Yeah, many companies don't offer it yet.
Right, there more and more are now. They're offering the Roth side of the 401k. So, kind of back to our original discussion of set it and forget it. You haven't looked at your allocations in a long time.
Right.
Well, should everything be going to the traditional 401k?
True.
Pros and cons. I mean, you might have a Roth provision in the 401k where you don't get the deduction today, but all the growth becomes tax-free.
Yeah, they just added it to my wife's company within the last 2 months, really, as the year ended.
Oh, really? Okay.
Yeah. So they just made it an option. So she was like, "Hey, should we put a little portion in there?" So so we just kind of split some things off a little bit so she could add a little bit to that component as well.
Yeah, because those are. I mean, again, I work with clients all the time that are nearing that stage of retirement. Did very well saving in the 401k.
Yeah.
Set it and forget it. They've accumulated a lot of tax deferred dollars, which now when we're running the math, they've got a big tax problem coming forward into retirement.
Well,
and we're now having to convert some of those into Roth monies versus maybe if they had done that up front.
Right. Yeah. And that's what I was talking to her about. I was like, well, with you being 45, you've got 20 years still.
Right.
So, there's nothing wrong with going ahead and starting right now. You still got the 401k that she's had for the last 10 years, which she's been with the company, but now she has this other option as well. So yes, it's worth asking your provider, is it something they do?
Absolutely. And again, there's no general rule of thumb in this, but from a high level general rule, I mean, I would say the younger you are, the more likely the Roth is going to work better for you long term. Not to say if you're older, you shouldn't be doing Roth. You may to get some diversification. Right. But the younger you are, you've got a lot longer for that money to grow tax free. You're probably in one of the lower tax brackets that you're going to be in your career. Hopefully, right? Hopefully your career is going to grow over time.
Right now,
and your taxable income is going to grow. So you really don't need maybe that tax deduction that the traditional gives you. So if it has a Roth provision, don't discount it and say, oh yeah, but then I'm going to pay more taxes. Well, you're going to pay taxes sometimes. So get used to it. They're going to get in your pocket sometimes. Just understand how it works. And Roth is a great vehicle to use. The other side of the 401k that I think often gets misunderstood is, especially for somebody that leaves them out there and doesn't roll them into IRAs as they leave, is in a 401k, you've got to be very conscious of what the plan provisions are for a surviving spouse. Because that's when things get really tricky. So an IRA is very defined, easy. Your surviving spouse can roll your IRA into their own IRA. And there's time frames that may or may not make sense, but there's much more flexibility and ways that they can handle that. That doesn't have to be offered in a 401k. 401ks, there's IRS rules, then there's 401k rules. And the IRS rules always have to be followed at a minimum, but the 401k can add a bunch of rules on top of it. that may be more restrictive than what the IRS rules are. And that's fine because it's a plan. It's when you sign up for the 401k, you're signing the agreement to here's the rules. Just understand what those rules are. And they don't generally favor surviving spouses. It makes it very difficult for them to handle the money and options that they might have. For instance, they might be forced into just taking a distribution or taking it over a certain number of years, versus being able to roll it into their own IRA at that point. So, so just understand, and don't forget beneficiaries. I mean, this is one of the key things too, especially having accounts all over the place. In fact, I was just working with a prospect that it wasn't them, fortunately, but it was somebody that they knew that this individual had passed and had forgot to change the beneficiary on his old 401k. And it was the ex-spouse that they hadn't been married in 20 years.
Oh, no.
And there's a lot of court law behind this. That 401k designation, whatever the beneficiary designation is in the 401k, is law.
Well, so there's some options, some things to think about, some top mistake issues that people could step into when it comes to a 401k. So just do yourself a favor and just, think about some of these things, clean a couple of these things up. Many of these are easy. You don't need a professional to help you with some of these. Some of these you can just do yourself, right? Don't leave them behind, roll them over, make sure you've updated your BD, thing like that, beneficiary designation. But then again, you may want to work with a professional. You may need some help in saying, there's just a whole lot of stuff to all these components that make up retirement. And 401k is just one. It's just one avenue.
One tool. One tool you have.
Right.
So
So do yourself a favor, have a conversation with a financial professional and get started today. If it's not Phil, talk with somebody in your area. Reach out. Of course, Phil serves clients all over the country. So if you need some help, reach out to him. 248-888-7530 is how you can call him. 248-888-7530. And you can also stop by the website, philstaxhacks.com. That's philstaxhacks.com. And for Phil and I, we'll see you next time here on the show. This has been Phil's Tax Hacks and other retirement facts. See you, Phil.
Take care.
Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.